the Hidden Wealth Tutorial Series. Live well, keep more. Simply, safely, and effectively. How to safely maximize your net spendable retirement income. The most common way of saving for retirement is participation in 401k, 457, IRA, and similar qualified plans. Yet participants are left largely unaware of the powerful economic impact participation has on cash flow, taxes, and the amount of retirement income they can safely take from those plans while facing the risk of unfavorable life events. Now, we discuss these things here, beginning with this question. Regardless of what generalized conventional wisdom may say, is a government plan good for me, personally? Shouldn't that be all that matters? There's too much at stake to guess wrong, so let's turn on the lights and take a cold, hard look at it. 401k, 457, IRA, and similar qualified plans, taxation. A discussion about plan participation must begin here. The full taxation is unavoidable. All the money must come out, and the full state and federal income tax must be paid on all the money contributed and on the growth it may earn at some point in time. Conventional wisdom says that you save taxes with 401k and similar qualified plans. Is that true? The answer is in three parts. 1. Taxation today. Plan contributions are deducted from income and put into the plan. No tax is paid on that amount at this time. Using an income of $50,000, a contribution of $2,500, and a tax rate of 20% state and federal, it looks like this. $2,500 is taken out of income and put into the qualified plan. Gross taxable income then becomes $47,500. At this point, it appears that the tax on $2,500, equaling $500 at a 20% rate, has been saved. Is that true? To test that, let's withdraw the $2,500. The $2,500 taken out is taxed and the $500 is paid. The withdrawal is added back into taxable income. The tax is paid and a penalty is applied, 10% federal and 2% state. Conclusions: you do not save the tax. You defer the tax on the contribution and on any growth it earns to whenever the money is taken out. Your net spendable income is not increased by making a plan contribution. You do not contribute $2,000 and keep the $500 of tax. The $500 that would have been paid now is put into the plan to be paid later. The tax deferred on the amount contributed is never yours to keep. 2. Taxation during the accumulation phase. Premature withdrawals. Qualified plans were created for retirement income. Money withdrawal from the plan prior to age 59 and a half is subject to tax at the rate in effect at the time of withdrawal, plus a 10% federal and 2% state penalty. Let's examine that. A $10,000 withdrawal is taken from the plan prior to age 59 and a half to pay off debt, maybe buy a used car or handle some other financial need. The tax on the $10,000 is paid at the current rate, plus a penalty of $1,000 is payable to the federal government and $200 to the state. The state penalties can vary. This is very lucrative to them. The federal government takes in about $5.7 billion per year in premature withdrawal penalties, plus the tax. The conclusions: qualified plans put locks on the money contributed. Breaking the lock is costly. Not breaking the lock is also costly. The forced loss of use of the money causes debt interest, and opportunity costs, that is, the lost future growth that could have been earned on the penalties paid or on the dead interest paid. Now, by their design, using qualified plans as a savings account is unsuitable, costly, and self-defeating. Number 2, taxation during the accumulation phase. Qualified plan loans. Again, qualified plans were created for retirement income with penalties for early withdrawal. However, loans may be taken from the plan without tax or penalty during the accumulation period. Let's examine that. A loan is taken from the qualified plan. The loaned money is not taxed. The law requires that loans must be repaid within 5 years or they become a withdrawal subject to tax and penalty. Loan repayment is made with after-tax dollars. After-tax loan payments are put back into the plan, replacing the pre-tax dollars that were there. Then, if those after-tax dollars are borrowed and repaid again, they will be taxed again. Then, as retirement income later, they will be taxed yet again. Conclusion: by their design, using qualified plans to finance our wants and needs is unsuitable, costly, and self-defeating. The cost is the multiple tax paid plus the opportunity costs. The lost growth suffered while the money is not invested, the interrupted compounding, and the lost future growth on the tax that is paid. This makes it an unfavorable financing option. 3. Taxation during the distribution phase. Retirement income. The qualified plan tax formula is simple. Untaxed plan contributions in, taxable dollars out. There is no way to avoid full taxation on the money put in the plan and the money earned in the plan. You defer the tax and the tax calculation. The tax is determined by the amount taken, the current tax rate, and the available deductions at the time the money is taken. The tax rate can be increased and deductions can be lost, creating tax rate risk in addition to market risk. Even at the same tax rate, ongoing inflation will require more to be taken out each year to equal pre-retirement income, while having fewer deductions. Paying more tax later than would have been paid today is more than likely. Whatever money that is remaining in the plan when death occurs can be taken as continued income by a spouse. Children, likely to be working adults by this time, may take the balance over a 10-year period. Adding this additional taxable income to their current taxable income will likely cause an increased tax rate. Or, the balance may be taken in a lump sum, creating more tax risk. The lump sum payout can create the current 48 to 50% maximum taxation rate. The minimum distribution rule dictates the minimum that must be taken and be taxed. Take too little in the hope of avoiding tax, and you pay a 25% excise tax penalty on what should have been taken. Taking the minimum required amount will keep current tax at a minimum for now, but creates the risk of the maximum tax of up to 48 to 50% federal and state later. How much income can be expected? Taxation of market invested assets, both qualified and non-qualified. Market down years and ongoing fees are inevitable. They both reduce account value. The future account earnings are reduced by the smaller account balance, which, in turn, reduces spendable income. We call it the Monte Carlo effect. If this is not accounted for, the risk of running out of money while still living is exponentially increased. Because of this, some financial advisors recommend taking income at a rate of 3% of the account value per year. Some recommend 4% withdrawals, which is considered a 30-year income target. Now, we use the 4% rate in our comparisons to avoid potential bias. Now, for that reason, we also use a modest 20% combined federal and state tax rate to estimate net spendable income. Assuming an account value of $1 million at the beginning of drawing income, a 4% withdrawal equals $40,000. At a 20% combined federal and state rate, the tax will be $8,000. Using a modest Monte Carlo effect and a modest combined tax rate, the net spendable income for a reasonable expectation of a sustained 30-year income equals $32,000 per year. Now, let's look at dividend-paying whole life net spendable income. Dividend-paying whole life contractual guarantees with no down years or investing fees provide a safe and reliable income base. Now, this allows income to be taken at a higher rate than market-based assets in two ways. Direct income may be taken from the cash value and dividends without tax. Indirect income may be taken by leveraging against the guaranteed death benefit without tax. The net benefit is fully guaranteed. This makes it an asset that may be leveraged to provide additional tax-free retirement income. Perhaps use it to cover long-term care costs should they arise. In this way, the policy owner can spend the death benefit while living. With the cash value being guaranteed, a healthy 65-year-old may safely draw income at a 5% rate per year. Now, at the same account value, being untaxed. Now, that is $50,000 net spendable income per year compared to $32,000 from invested assets. Plus, the net death benefit may be used to create additional tax-free income and benefits. Then, upon death, any remaining balance is payable tax-free to the beneficiaries compared to any remaining balance in government plans being taxable. We do not assume that gross account values will be equal. Actual market returns and life events will determine that. We can say that it would require a cash value of only $640,000 to draw the same $32,000 net spendable income from a $1 million 401k. We use MoneyTrack's financial software to provide future income projections to help in making informed and effective decisions. Here, we look at how to spend the death benefit while living in more detail. The policy has two parts, the cash value and the death benefit. Subtracting the cash value from the total death benefit, we determine the amount called the net death benefit. Cash value, net death benefit. The cash value and the death benefit are both guaranteed for life, making them separate income-producing assets. The cash value and dividends can be used to obtain tax-free income for life, as shown on the previous slide. The death benefit can be accessed for tax-free income while living through leveraging. This is in addition to the tax-free income from the cash value and dividends. Being a fully guaranteed permanent asset, the net death benefit can be safely leveraged. That is, spend down other assets which would be replaced upon death for a spouse or heirs when the death benefit is paid. It is a tax-free transaction. Leveraging potential includes, but is not limited to, recouping for a spouse or heirs, home equity taken as tax-free reverse mortgage income, recouping home equity or other assets used to cover long-term care costs or critical illness costs, tax-free, recouping the value of other assets spent for income, tax-free, converting an existing mortgage balance to a reverse mortgage with no payments. Use the death benefit to pay it off at death. The tax-free death benefit, guaranteed payable whenever death may occur, acts as a refund to a spouse or heirs of spent assets. Like money in the bank waiting to be paid, the bigger the net death benefit, the greater the net spendable income potential. How to spend the death benefit while living is covered in the Found Wealth Manual given to all of our clients. The amount of the benefit should be calculated at the time the income would be taken, when all the factors are known, including the state of health and the amount of assets that exist at that time. Now, for most, it's like getting a 25 to 30% raise in spendable income during retirement. Note, the net death benefit is an asset that would not exist by owning term, universal life, or indexed universal life insurance. By contractual design, they do not provide a lifetime guarantee. This eliminates them as a safely leverageable asset. In closing, about 25% of 401k and IRA plans are Roth. The Roth income taxation differs from traditional 401k and IRA plans in that after-tax dollars go in, untaxed dollars come out, subject to government-mandated limitations. The Roths have the same governmental controls as traditional 401k type plans on any growth that may be earned. They have the same fee structure and the same risk exposure. As with all market-based investments, fees and down-year costs never stop, so the same 4% income withdrawal rate applies. If we fail to account for all related costs in our decision-making, we are focusing on a wrong bottom line. In real life, fulfilling our wants and needs is an ever-present fact of life. It comes first, and it never stops. So, when taxes and penalties put locks on using our savings and invested money, they create financial and economic costs. Either principal and interest cost on debt is paid, the tax and penalty is paid, or the cost of paying cash is paid. All of them create opportunity costs. That is, the lost future growth on what is paid. Any money removed from the plan for present needs creates the opportunity cost of lost future growth as well. In that way, the gains we see in the plan go out the back door unseen. That means acknowledging the financial, economic, and investing costs that are embedded in our cash flow, and putting in place the means to recoup them must come first if we hope to keep and grow our savings and investing gains, and to safely maximize our net spendable retirement income later. The economically related costs we have itemized occur outside the plan. The banking and financial industry does not acknowledge the opportunity costs they create. They're not seen in statements. We don't get a bill for them, so they're not accounted for in our decision making. The impact they have on reducing our cash flow and our net spendable retirement income is felt, but not seen, unless a cash flow analysis is done. Most 401k, 457, IRA, and similar plans are self-managed. Over the last 20 years, the average gross rate of return on them ranged from 5% to 8%. Let's assume everyone gets 8%. From that, we must account for fees averaging 1.5%, the down-year average cost of 1.6%, and about 0.5% for term life insurance, bringing the return to 4.4%. Then, deducting the combined cost of financing our lives, because our money is locked up, brings the return to near zero or a negative true net number. Then, the tax on contributions and their gains is paid when the money is taken out. All told, the gains that may be seen in the plan are offset by costs outside the plan. If there is an employer 401k match, the costs still exist, but it will increase net spendable income. If there's a 25% match and we simply assume a 25% income increase over the $1 million account value example, The 401k net spendable increases from $32,000 to $40,000 compared to the dividend-paying whole life net spendable $50,000. It's fair to question why we include external costs in calculating net investing values. We do that to balance the playing field. Now, legacy banking with dividend-paying whole life will recoup them. It will recoup debt principal, debt interest, and the future growth on the principal and interest that would otherwise be lost to us. It will recoup the opportunity costs of paying cash. Now, these benefits are in addition to the 4 to 4.5% net rate of return after all costs a legacy banking design policy currently achieves on its own without using its legacy banking potential. Plus, there's the death benefit that comes with it. Dividend-paying whole life insurance is the only financial product that gives us the economic characteristics needed to recoup costs, to get uninterrupted growth at the same time, to have a guaranteed leverageable death benefit, and the contractual guarantees necessary to enjoy a safely maximized retirement income cash flow later. The infinite banking concept that we simply call legacy banking gives us the process to do that, and it's the only known way to do it. Everything is measurable. Net spendable income alternatives can be compared easily and accurately with our MoneyTrax financial software. Do you have questions? Would you like us to do a future income analysis for you? Email us at info@mymoneyflow.com. And P.S. Due to amortization, the true cost of bank financing is 2 to 4 times what most of us think it is. Due to investing costs, the true net returns on investing are about half of what most all of us think it is. That puts us financially upside down without knowing it. Our video tutorial, Legacy Banking in a Nutshell, shows how to flip the script and reverse those results. Thank you.